Hi everyone, welcome back to our video series titled Investment 201. In our first episode, we talked about tariff and deglobalization, and in our second episode, we talked about investing in China. In today's episode, we'll be talking about the investment formula, alpha plus beta minus cost. Join with me today is Dr. Peng Chen, Senior Advisor to Providend. Hi Dr. Peng, great to have you back.
Asik, it's great to be back.
Right, so let's just jump straight into this topic. For this investment formula is something that you coined, and really let's could you explain to our listeners on a high level what this formula is and why did you feel that there's a need to coin it?
Sure. So when I obviously studied finance and investment, and I learned a lot at school. And during the later part of my career, the last 10, 15 years, I increasingly have to communicate these investment concepts, logics to individual investors or financial advisors. And I find that I need a simpler framework to help convey the very basic concepts of investment and investment portfolio to these audiences. So I started experimenting with it, and pretty soon I find this ABC and risk is a very good way to do it. And I wrote a couple articles on that, and people really liked it. And so I'm starting to use it. As a matter of fact, I'm writing a book on ABCs of investment, basically talk about what you just said, alpha, beta, and cost, plus risk among different asset classes and how they behave and how should they be put together in the portfolio. And hopefully the book will come out soon.
Yeah, look forward to it. So why don't we break down what alpha, beta, cost, and of course risk is for our listeners. So let's start with alpha, right? So what is alpha?
Alpha is probably so alpha is the term we describe as extra returns. So what does it mean? Is basically above and beyond what the market delivers to you. So we say when we are investing, we're investing into the stock market, the bond market, the real estate market, and so on and so forth. And as an investor, when you participate in this market, there is this market average returns you can expect to get. And that's beta. We'll talk about beta later. But oftentimes, investor will want to get extra returns above and beyond what the market give it to you. So for example, let me give you an example to illustrate that. For example, if I were going to invest in a Singapore exchange listed stock, and the Singapore exchange, all the stocks in the exchange form what we would call the Singapore stock market. And then that had produced an average return, often represent the Singapore stock market, to some degree the Singapore overall economy, and so on and so forth. Now, if the stock I buy performed better than the Singapore Stock Exchange overall, then I would have a positive alpha. And if the stock I bought performed worse than the Singapore Stock Exchange, then it had negative alpha. Now, all of us obviously want to have better extra returns, so a lot of effort is pouring in to find the better stock to perform than the overall market. However, I must point it out, because stock market is based on a buy and sell. So for example, I like this stock. Let's say I like Singtel. I really like Singtel. I think Singtel will give me a lot more return than the stock market average. I buy Singtel, but someone else would have to sell it. Otherwise, there's no transaction, there's no buy. So that means that if I bought Singtel, Singtel went up, I got extra return. Someone else sold Singtel, actually lost that extra return. So you can see it's actually a zero-sum game. If I win, someone else has to lose. Someone else win, I got to lose. So this alpha is at the very primitive form is a zero-sum game. Now, often there's cost. So if I buy and sell stock, there is transaction fee, there is a bid-ask spread, and once you incorporate these costs and fees, it's actually a negative sum game, meaning that not only I have to beat my counterpart, meaning that I have to figure out whether I want to buy or sell and win that extra return, but also I have to overcome the higher cost. So this is what we call a negative sum game. And so this makes the game, the odds of generating positive alpha returns on average much more difficult.
Right.
Less than 50%.
Right. So in summary, when you make a trade, you're buying something that someone feels that they should offload.
Yeah.
Right? So it's a zero-sum game because it's either he's right or you are right.
Exactly.
Right? And of course, you have to consider things like, of course, the average market return and of course also. So maybe before we go into that, let's talk about beta, and then we'll go more in depth into cost as well.
Yes, sure.
So what is beta, right?
So beta is basically when we are investing, we often invest, let's say the common asset classes are stocks and bonds. And if you look at how we invest, at the end of the day, it's really we are providing financing to different entities to produce goods or services, and they sell in the market, and in return they generate profit, then they pay you back, right? So that's the process. So in essence, if you peer through the simple buy and sell, when you are investing in a stock, you're basically providing financing, equity financing to the company. And the company would then use the money to produce goods and services and then sell in the market, generate profit, and return the profit to shareholders. Now, different other form of investing would be bond. So as a bond, you're lending money to the company, and the company would use the money to do all the things we just talked about. Now, these different forms of financing economic activity carry different amount of risk, because as a bond investor, you are entitled to collect your interest, or in the event the company went bust, to collect back your money ahead of the equity investors. And so the bond investor's risk is lower. The equity investor's risk is much higher. So these different forms of providing financing through the capital market, because the different risk characteristics resulting in different returns. Because higher risk, people expect higher returns, lower risk, lower returns. So over time, we call these different ways of providing financing and generating these returns, these different profiles and pattern of returns, we call these beta. So basically, that's the logic. How does it exist in the market? Basically, if we look at, let's say I want to invest in the US large cap company stocks, and I would look at S&P 500, and if I invest in the S&P 500 index portfolio, it will generate overall series of returns over time. And that return and the risk characteristic associated with S&P 500, we would call the US large cap beta. So it's basically the beta represent a diversified asset class risk and return characteristics.
Right. And they always use a number when they're talking about beta, right? So beta of 1,
yes.
Beta of 1.5.
Yes.
So I assume if you have a beta of 1, that means that you match the characteristics of the market. So if your portfolio has a beta of 1 and you're investing in US large cap, for example, that just means that your portfolio essentially is moving very closely with the US S&P
exactly.
500.
If you have a beta of 1, it basically means that part of your portfolio, it moves up and down exactly the same as the US large cap market. or whatever that beta is. So whether it's a stock market beta or bond market
US
beta,
market,
US market,
Singapore
Singapore
market.
market. So there's different type of betas. And so, and you can see, because it's an index, it's an overall market, you really don't need to pick and choose. There's no need to figure out Singtel versus DBS or, some other, constituencies in the index. You just buy the entire market, and by participating, by providing financing to the entire market, you're entitled to a certain amount of risk and return. And that's what we call beta. So there's no, compared to alpha, you don't have to beat someone. It's not a zero-sum game, because over time, economic activity, is positive growth. It generates profits. So it's not a zero-sum game, and you don't have to beat someone to get that return. So everybody can participate. So that's the difference, beta. And also because you don't have to, thinking about, should I buy Singtel or should I buy DBS? And then tomorrow, maybe I need to sell Singtel, buy DBS, and so on and so forth. It took the cost of doing these analysis, managing the portfolio, much, much lower compared to if you were going to generate alpha. So the cost is also lower for beta. And also, it can accommodate literally everybody who want to participate.
Right. So if you, just in summary, in terms of alpha and beta, beta basically means diversifying across that market, the particular market. There's a beta of 1, right? That's perhaps the most sensible thing that most people should do. And alpha is really trying to beat what beta is giving investors. But of course, with that, we have to consider things like risk and cost, which we will talk more about later.
Yeah, so if you compare the beta and alpha, we got into a little bit. Beta returns are associated with fundamental market, how the economy works. And like I mentioned, everybody can participate. So it's not like, okay, I couldn't buy this or I couldn't buy that. There's a lot of capacity. You can participate, and over time, you'll earn return. This is the basic form of return every investor should earn. So whether you have skills or not, whether you can beat someone else or not, you're entitled, I need to say, you're entitled to this return. So you better get these returns. Now, alpha is very different. Alpha requires you to do better than at least half the participants, and some, more than half the participant, to be able to generate some alpha return. And even that, it's very difficult to generate consistent alpha. And also the capacity is small. So for example, if we believe Singtel is a good stock and it will generate alpha, then many more people will probably figure it out same. So they would buy Singtel, bid up the price,
and there's no more alpha.
And then there's no more alpha. So alpha is not constant. It's not like, oh, Singtel is a good stock, then there's always alpha. No, it's transitory, and you have to be on alert all the time to be able to generate that. Where beta, you can just almost buy and hold. And to illustrate these two very different characteristics, I'll tell a story. The word most famous investor, very skillful in terms of picking stocks, is Warren Buffett, right? He's probably the best in terms of generating alpha. For 60 plus years, he has demonstrated he can do that, and consistently. But even him suggested for most investors, the best way is to more focus on beta rather than alpha, because it's so difficult. And he even made a famous bet with a couple of professional hedge fund managers, which are also very skilled at generating alpha. The famous bet was made shortly after the financial crisis. And the bet is that these hedge fund managers felt that they can generate more alpha to beat the S&P 500 stock index, which is the beta. And Warren Buffett took the bet. He said, okay, I will take S&P 500. You guys will try to generate alpha and beat it. And it was a 10-year bet. And these hedge fund managers, they covered themselves a little bit. They formed 5 different portfolios, actually 5 different hedge fund portfolios, basically alpha pursuing portfolios. And after 9 years, none of the 5 come close to what the S&P 500 has delivered. So Warren Buffett win, $1 million.
Yeah, thanks for sharing that story, because it really gives some context to our listeners. Because it's not just that if you commit more time and you really spend all your energy on it, you can for sure get alpha, right? I mean, based on your story, we can see that those are famous investment professionals. They have a team of analysts. They are looking at the markets around the clock.
Yes.
And they are still not able to outperform beta.
Yes.
And over a long period of time, of course. So I think that's good to provide that bit of context, because it's quite counterintuitive in every other aspects of life. The more hard work we put, the more dedication we put into certain things, we get better results. But we really don't see that for a large majority of people when it comes to investing.
Yes, because first of all, you have to look at your ability, whether you can do it. And secondly, what I think is the most significant thing, which we'll talk about, is the cost. Because the more you try, you essentially put in more cost. The amount of time, all these other resources you need to deploy to study, and also as individual investors, we don't have the resources to compete. I'll give you another example. There was a famous movie I always quote. In the US, there's a few different exchanges. And as we mentioned, to produce alpha, you need to have an edge. And one of the asset managers figure out that one of their edge is to get the transaction price that happened on the exchange faster to their own computers. And one of the particular exchange in the US is Kansas City. And so to get the data from Kansas City faster to their computer in New York City, which is about, I would say about, 1,500 miles away, Kansas City to New York City. What they did was redug a cable line that goes straight. So the old cable line was dug in the 1800s or whatever, so it goes to Kansas City, to St. Louis, and then maybe to Chicago, and then all of Pittsburgh and all of that. So it's not a straight line. And to dug a straight line would have saved, I think, 0.2 second. Because the straight line is faster.
Data can travel through the cable faster.
So the movie was about these 2 young guys was asked to dig through, for a new line. They spent $2 billion.
Wow.
Just to get an edge of 0.2 second. And so you can think of, for an ordinary investor, we have no ability to compete. It's kind of like they have aircraft carrier and satellite, where we are still fighting, with a stick. With bows and arrows. So that's why, for most individual investors, it's much better off to pay more attention on the beta part and less on the alpha part.
Yeah. And that's who is at the opposite side of the trade, right? I think
exactly.
So
you're trading with the guys putting in $2 billion to get the data faster for 2.2 seconds, where we're relying on our slow internet at home. So there's no way we can compete.
Yeah, and I think it's a good segue in terms of cost as well, right? When you're talking about alpha and beta, you mentioned cost because it's such an important factor. So
yes.
Maybe you can just dive deeper and unpack, what you mean by cost.
So the cost oftentimes basically means, if you look at any investment, right, there is a raw investment return. So for example, if we buy the S&P 500 index, the S&P 500 index will produce a raw return. But how we buy it make a great difference, because the cost directly come out of our raw returns. And every dollar the cost increases is a dollar more we pay. And unlike the returns that has some uncertainty, sometimes it's higher return, sometimes it's lower return, depends on the market, the cost is always there. So you save a dollar, you basically get $1 more return. So we always pay a lot more attention on the cost, because very certain, if I lower my cost, my return will be higher, regardless of what else happened. And so cost is very, very important. And particularly when it comes to beta and alpha returns, we got to be very careful on these costs. Try to find a lower cost instrument, save money, and the money you save goes back to generate more return. And this is why at Providend, I think Chris over the last couple of years wrote a series of articles, talked about, I think the term he used is relentlessly pursue better investment options. And if you read those articles, one of the reasons to be relentless is on lowering the cost for our clients.
Yes, so to our listeners who are interested in the article that Dr. Peng is referencing, you can refer to the link below. But it's true, I think behind the scenes we have a relentless pursuit, and one of it is, of course, to find a lower cost option for our clients, right? I think even if the difference is a few basis points, right, is something that we will consider, and we'll make the switches if necessary, because like you mentioned, every dollar that you save on cost is every dollar that goes to the investor.
Yes.
Right. But let's dive a little deeper into
Sure.
the various types of costs.
Sure.
Right? So how do we? What's if let's say I'm an investor, right? What kind of costs? If you can break down the cost that I will incur,
right,
what would those be?
So typically, there are, I would say, three type of cost. The first one is sometimes called access cost. So meaning that if you want to buy certain investment, you have to pay an upfront fee to buy it, or sometimes called subscription fee, right? And if you want to sell a certain kind of investment, you have to pay a redemption fee. So that's a subscription and redemption fee. These days, these fees are almost zero now, because there's many investment options, and to me at least, it seems foolish to provide capital to someone, and but to provide that capital, you have to pay them to take your money. So these days, I think the first category, redemption and subscription fee, almost zero. Now some platforms still charge it, but most of them do not. Then let's talk about if we're using a unit trust or funds or ETF as our main investment vehicle, there is a management fee. So basically what happened is that, as like you and I could buying the same funds, the fund company collecting money from all the investors, pool it together, and would then go invest on our behalf. And then they would distribute the cost according to how much money we each invest as a management fee. And that covers, for them to manage the money for us, whether it's an index option, ETF, or active management. So that's typically what people will see. That's the fund management fee or unit trust management fee. Then the last part, many times people don't get to see, for example, is the trading cost. It's the bid-ask spread. So it's I wouldn't say it's hidden, but it's somewhere tucked away that you need a bit of a professional understanding and professional knowledge to be able to process it. And so that's the what sometimes I call implicit fee. And sometimes there's not a very clear number that you can point to. Unlike the management fee, which I would call it the explicit fee, where it's clearly stated how much, what's the percentage of management fee, whether it's 0.5% or 0.2%, and so on and so forth. But this implicit fee is embedded in many unit trusts and funds, particularly when funds sometimes have very high turnover. They would have to pay a high transaction fee, but also they would have to pay a bid-ask spread. Now, what is bid-ask spread? So normally in the market, when you want to buy something, you look at the market price. If you want to buy it right now and buy it quickly, then you have to pay a little bit above, because otherwise there's other competing buyers, right? So it's a competitive bid and ask spread. So you have to bid higher, and if you want to sell, then if you want to sell it quicker or sell more, then you have to offer at a lower price. So this bid and ask spread depends on how fast and how much you're trying to trade, can be a pretty significant cost. So for example, if I'm an apple farmer, I want to go to the market and sell apple, and I want to sell a lot of apples today, but other people are selling same quality of apple at $10. I probably have to sell it at $9 or $8 to attract more customers, right?
Yeah.
And so I have to sell cheaper. And this $1 or $2 price difference would be cost for me. But it's implicit, right? And same token, if I'm buying Apple, I want to buy a lot or buy it faster, I have to offer higher. And so these are costs embedded in how I manage money and how I trade, and doesn't necessarily reflect on the management fee, but costs investor money nonetheless.
Right. So there's a lot to unpack, but to summarize, there's three different kinds of costs, right? Excess, implicit and explicit costs, right? So excess costs would be things like subscription or redemption costs.
Yes.
Like you mentioned, that is almost eliminated in
Right,
today's market.
Right. Very competitive market,
Very competitive.
eliminated.
Yes. And there's explicit costs, which is costs that are very obvious in a way. Can I say that?
Yes, very obvious. It's stated in the fact sheet of a unit trust, or in their semi-annual report or annual report. So very obvious.
Yeah, and there is those implicit costs, right? Could be things like when they're performing a trade, the bid-ask spread. That spread is actually incurred by the investor. That's not usually very obvious. If I can add maybe currency conversion as well.
Yes.
Right?
That's another type of trade. Yeah.
Yeah. So especially if, let's say, we are a Singapore investor, we don't think too much about it. We convert our currency on our brokerage accounts, and we invest, and we don't account for those fees that we paid, and it's quite hidden. So that is also classified as an implicit cost.
That's correct. Okay. So as an investor, you really have to be aware, how much it costs you to invest, right? And particularly on alpha investment, because oftentimes these alpha investment incur more trades, and the cost is higher, and you might think, hey, I'm getting some extra returns in the form of alpha, but the reality is that after you're counting all the cost, there may not be anything. So we got to be very careful. In general, we got to be careful about cost when it comes to alpha generating portfolios. We got to be even more careful.
Right. Okay. And the last part of the formula is risk.
Yes.
Right. So risk is a tricky one, right? Because many different people have different definitions of
That's right.
risk.
That's right.
Right. So, Dr. Peng, how would you define risk?
Well, it really depends on who I'm talking to, right? What's their financial goals and so on and so forth. So for most individual investors and our clients of Providend, I would say the way I look at risk is two things. One is the inability to reach certain financial goals, because that's the most important thing. And then the second component is that at any given time period, if the portfolio goes up or drops down quite a bit, it made our client or investors uncomfortable, right? One is not to be able to meet the goal. I think that's the most important risk. The other one is, okay, if the portfolio drop a lot, the investors would not feel very good, and worse would be, okay, there's a lot of risk, maybe I need to pull out or make significant change to the investment strategy. Because also that's how I define risk. The reason I put it into the ABC formula is just to make sure people understand that oftentimes in investment, we often think about returns, because those are the good aspect. Okay, I get 5% return, I get 10% return. But we cannot forget return and risk are hand in hand. The higher returns that we like are often coming, or almost certainly comes with higher risk in different shape or form. And so when we look at returns, all of these different components, we would always ask ourselves, hey, what's the risk? Where is the risk coming from? Is this going to significantly jeopardize my ability to reach my goal? Or does it have so much short-term risk that my portfolio may drop to a level I feel uncomfortable? So you have to always remind yourself, when you're talking about investment, talk about portfolio, what is the risk? And I would also suggest, actually, before we even get into the alpha, betas, and cost, I would ask the risk first.
Yeah, so at Providend, we always ask what's your need to take risk, what's your ability to take risk,
That's
which
correct.
is often associated with your time horizon, and of course, the willingness to take risk, which is whether you can stomach the volatility.
That's right, and your goals and all of that. So these are very important, yeah.
Yeah, I think on the point of that, it's true, right? If we look at a fund or a portfolio manager that has like a few percentage points alpha over the beta, right? You might think that, oh, okay, why don't I invest with this person, right? But when you look back, you can see it's swinging wildly.
Yeah, it could be.
It
could be. Yeah. So don't just look at the returns, but make sure that you take a greater look at the risk. And sometimes, for example, a friend showed me a investment option a couple of days ago, and it does generate a bit of extra return. Not a lot, maybe 0.3% per year, but you have to lock in your investment for 10 years. So you lose your liquidity. And I explained that this liquidity is a huge risk, because what if you need it, or what if circumstance dictate you need to adjust? Because you locked in, you couldn't do anything. And so in that situation, if this investment requires you to lock up for 10 years and you cannot change, then they ought to compensate you more. Yes. And in general would be around 1% to 2% a year. So yes, you may on paper look at, okay, they're giving me 0.3% more. That's quite a bit. But in reality, you're losing out because you didn't take into consideration of this liquidity risk you are now incurred in your portfolio. So the risk is not just the market changes, mark to market, but also in the form of liquidity and many other forms. So you really have to think it more comprehensively.
That's a good point. And liquidity risk is something that people often underestimate. I always share with our clients that if you don't even need to think back 10 years, right? Just think back 3 years ago. Your life is quite different from today.
Yes.
And it's probably going to be quite different 3 years from now. We just don't know when. And that's where we really need that flexibility, that liquidity, right? And if you want to sacrifice that, you better make sure that it's the alpha that you're getting is enough, appropriately compensated.
Yes,
right?
That's exactly the point. That's why I told him. I said, look, for investment that lock you up for 10 years, normally they're offering 1 to 2% higher, and you're not getting it. So this is not a good investment. So risk is very, very important. We cannot forget risk in investment. So in essence, this A, B, C plus risk, these are the 4 components I think that are most important, are the most basic and also the most important component when you look at any investment option. And pretty much every investment option, whether it's stocks or bonds or funds or gold, you can kind of separate these, and it became clear what the characteristics, how do you look at it and manage it. Yeah.
Right. A lot of people feel that they can eliminate risk, right?
Yeah.
Have their cake and eat it in a way, whereby if let's say they feel that if you diversify across stocks, bonds, and beyond stocks and bonds as well, right, into gold, into commodity,
Sure.
perhaps even crypto,
Yeah.
they're able to get the returns, but at the same time eliminate risk.
Yeah.
Right. So do you believe that by diversifying across various asset classes, we can eliminate risk? Or recently people are using options to try to eliminate risk, right? So what's your opinion of that?
Yes.
Can we truly get returns without having to incur risk?
So the first principle people need to understand is that risk and return go hand in hand. So if you eliminated all the risk, I don't care how you do it, your diversification or use options to hedge it away or buy insurance product, whatever you do, if there's no more risk, no more uncertainty in terms of how much return you're getting, the return will be very low. It would become a safe investment. And the safe investment without risk, by definition, cannot be very high, because risk and return go hand in hand. You cannot say, oh, I want a very, very safe, no risk investment, but give me very high return, because it doesn't exist. If there is, then everybody would buy it, and it no longer exists anyways. So in that sense, you really got to understand, like you mentioned, how comfortable you are with returns. The objective for investors, whether it's institutional or individual, is not eliminate risk. It's about what's the right amount of risk I can take. And that right amount of risk will lead to more returns for me than a total safe investment. So that's the first thing. The second thing is that to diversify is a good thing, but diversification can only mitigate risk. It cannot eliminate. So it can mitigate what we call in finance the idiosyncratic risk, but it cannot eliminate systematic risk. What do I mean by systematic risk? We have just seen there's a lot of hot conflicts, right? So for example, Iran and Israel are in conflict right now. And if I had invested in Iran or Israel, maybe a better example, no matter which stock I invest in, is going to be impacted by this conflict. And that's a systematic. And even if you're not an Israeli firm, even if you're just a stock in US or in China or in Singapore, to some degree will probably be impacted. And this is systematic. There's nothing you can do about it, right? Another example would be COVID. Right? It's systematic. It impacts everybody, every company. Now, some positively, some negatively. But this type of uncertainty you cannot eliminate. It's a systematic risk, where what you can eliminate is that, let's say, this is General Motors and Ford, and the General Motors made a mistake in one of their car designs that dragged down their performance, and Ford didn't. And you can diversify, and that help mitigate that. But systematic risk like COVID, like wars, or weather, you can't just say, look, let's get COVID, take care of it. So these are risks you cannot diversify away, and they will always be there. And because a lot of these risks, like I said, associated with returns, the right way, like I said, is to figure out how much risk you're comfortable.
Right. So in summary, I think to your earlier point, if there is any arbitrage, if there's any alpha that you can get without risk, that is gonna be quickly
everybody wants
eliminated,
that,
right? Everyone will go
everyone
there.
Then the opportunity is gone.
Yeah.
It's kind of like I remember years ago, Singapore airline, there was a technical glitch where you can buy, I think, long distance flight, with a few $100s, and pretty quickly people found out there was like hundreds of people trying to book, and in that opportunity is gone.
Yeah, that's a great example of how this kind of opportunities very quickly go away. And to your second point on why it's very difficult to eliminate risk is, of course, we can diversify away idiosyncratic risks. A risk of a single company collapsing, or maybe Elon Musk tweeting something that causes Tesla share price to crash. But we cannot diversify away, or it's very, very difficult to diversify away systematic risk, right?
Yes,
Which is like, and we see it during times of like a global crisis, for example, COVID-19, for example, or geopolitical conflicts that cause markets to be volatile.
Right.
So, Dr. Peng, at Providend, we always say that we strive to help our clients to achieve not only their financial goals, but their non-negotiable ikigai goals as well. So do you think that your investment formula can apply to something that is beyond just investing, like in terms of our clients' life goals?
Yeah, the way I think about it, it has a lot of similarities, maybe not identical. So when I approach life goals, I always ask myself, what is the risk around, this goal, or what are my actions and all of that? I need to understand, how bad it can be, right? I cannot just look at the rosy part of this, right? So I have to look at, the uncertainty part. That's come to me. That's the risk. And then I would sort of break it down and then say, okay, what are the things that are the easier, I can get some easy score, easy wins, and I'll make sure I get those. And then there's more challenging ones, and I'll try my best, but also try to align with my interests so that it's not so boring to me. I at least doing it and enjoy it. And then always, make sure you understand the friction, which is the cost of achieving something or doing something. Try to minimize that. That will significantly increase, the chance of your reaching the goal successfully. So I think investment and life goals are similar in many senses. So managing your risk, lower your cost, make sure you get your betas, the easy ones, the layups, and then try your best at the alphas.
Right. So in summary, get the easy wins.
Yeah.
If you want to get the alpha, be mindful of your cost.
Yeah.
And whether you're sacrificing any of those easy wins, and also the risk.
Yeah. So in the sense that if I manage my risk, I relentless lowered my friction and get all my easy ones. And even if I don't get a lot of alpha, I think the outcome would be pretty good.
Right. Okay. So let's end on that note. So thank you so much again, Dr. Peng.
Thank you
for your time and insights today.
Thank you,
So
Isaac.
for all our listeners, I hope you enjoyed this episode. And if you like this episode, please remember to subscribe to our YouTube channel if you have not done so already. So as always, thank you all for watching, and I'll see you all in the next episode.
Thank you.
All analysis, views or opinions from interviews, recommendations and other information broadcasted, podcasted or published herein are provided for general information purposes only. Information expressed does not take into account any specific situation, particular needs or objectives, and should not be construed as specific advice or a recommendation. Information has been obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed. Always consult with a qualified investment, legal, or tax professional before taking any action. Providend Limited does not accept any liability for any loss whatsoever arising from any use of the information broadcasted, or published herein. All contents and information contained herein may not be copied or reproduced in whole or in part by any means without prior written consent of Providend Limited.